It's a big week for housing with a number of reports on deck. We will get a look at home prices tomorrow with the S&P Case-Shiller Index, as well as new home sales for August. On Wednesday, a look at pending home sales. And on Thursday, the latest reading on mortgage rates, with rates currently sitting at the highest level that we've seen since 2008. Now, for more on this, let's bring in Nadia Evangelou, National Association of Realtors, Senior Economist and Director of Forecasting. Nadia, it's good to see you. So a big question here, especially for those looking to buy, is how high rates are going to potentially go. What do you think?
Sure. Hi, Seana. So what we see is that mortgage rates have doubled, surpassing since the beginning of the year, surpassing the 6% threshold. So now the borrowing costs about like 60% higher. Look, so now buyers, they need to spend about like $800 more. With the Fed raising even further, having like more rate hikes, so we expect, and inflation running still very elevated, so we expect mortgage rates to continue to rise. So we should expect for the following months to be around like 7%.
And Nadia, obviously with prices so high and obviously mortgage rates so high, it's having a lot of people sort of staying put who potentially would have moved or would have sold. What is that low mobility then also doing to the housing market?
Yeah, generally, rising mortgage rates lead to lower mobility rates. Like over time, like owners may be locked into their existing like homes as mortgage rates like rise, while the 3% rate from last year may not be back like anytime soon. Meanwhile, on top of higher mortgage rates and home prices, moving costs has also increased, like inflation like runs above 8%. Thus, all these factors make it like more difficult for homeowners to move and purchase the next home. In the meantime, that's the reason that it's a little like worrisome. We see that the mover rate reached a new historical low in 2021. Like, although millions of people like moved during the pandemic, like driven by the opportunity to work remotely and the desire like for more space and better affordability, the U.S. migration continued to decline in 2021, even though like we thought that more people were moving around. However, this is not a new trend. Like mobility gradually like declines over the past like decades. And to give you an idea, like back in the 1980s, for example, nearly 1 in 5 Americans moved every year. However, only 1 in 12 Americans moved in 2021. Thus, the rising borrowing costs may drop mobility rate like even further. But how it may affect like the real estate market, like a lower mobility translates to fewer homes available in the market, as fewer people like are selling their homes when we actually need more inventory. Thus, while our country is suffering from a severe housing shortage, lower mobility can make like housing inventory even tighter and can cause like home price continue to escalate. However, I think homeowners should consider that they have already accumulated like substantial like equity in the last, especially couple of years. Like, for example, if they bought their home 2 years ago when rates were about like 2.9%, they have built about like 80,000 like in equity due to the price appreciation. Or owners who bought their house like 10 years ago, their home is currently worth about like 200,000, like more than then.
So Nadia, what does this then do to home prices? Because we heard Jay Powell, Fed chair, last week saying that we could be in for a correction. Lots of speculation, lots of thought out here that we will see home prices start to decline. But will that decline then be even slower than we initially thought?
Yeah, we expect that we see a deceleration. There's a gradual deceleration of home prices. Like home prices have increased like year over year by less than double digits. So we don't have any more double digit percentage like change for home prices. And while rising mortgage rates, home prices like hurt affordability, many buyers are priced out of the market. Like nearly about 20% of the households across the country can no longer afford to buy the median price home compared to last year. So with fewer buyers in the market, demand has cooled. And in normal conditions, decline in demand makes home prices to drop. However, demand for homes continues to outpace supply, and inventory may have picked up, but it isn't enough to make like home prices to drop. And while housing inventory will remain tight for the next at least like couple of years, we don't expect the depreciation of home prices. We expect home price like growth to slow at a rate like 5% by the end of 2022. So for 2022 to have like on average about like 9%, and then the next year to have like about like 1% increase in the home prices in 2023.
And we are seeing a bit of a difference between some of these single-family homes and multi-family homes. What are your expectations as to how those two are going to develop going forward?
Indeed, we see like multifamily construction that even though the last figures were not like very encouraging, but however, what we see that multifamily construction is advancing compared to single family homes that we see a decline. And this is what we expect. We expect like fewer homes, a decline on the single family homes for 2022. However, multifamily to continue to outpace about like 20%, like more multifamily homes in having inventory. This is very good news for renters. It seems like rents are rising also very fast at the 4 decades high that we have. So we want to see like even more inventory for both like multifamily and single family homes.